welcome back. And we're moving into our first conversation for today as we continue our conversation on understanding the Superbond. At this point, we're going to be talking about the way forward. And joining us from Legacy Fund Limited is Ervin Perez. Good morning and welcome back.
Hi, good morning.
Yes. Ervin, it's always nice to have you in. Whenever you're here, we know for a fact it's going to be something in finance. Then again, whenever you walk around, you've got your calculator, and it's not any calculator, it's a scientific calculator.
It's a business.
Yes, it's, But we've heard so much about this bond. We did the first segment to get a second one. Now we're in the third one. Folks, to a certain extent, might still be puzzled about a lot of things. One of the things we wanted to do was to touch on a brief history of the Superbond.
Yeah. So one of the things I realized is I was working with one of my junior staff at our firm looking at presentations on the Superbond. We were supposed to do a presentation to some UB students. And when we look back, I realized that we've been dealing with the Superbond for over 11 years, from 2006 and the whole conversation. And the junior staff is like 21, 22. So they were like 10 years old. Wow. And so when I had indicated in the initial presentation that it was a previous People's United Party administration that had dealt with the Superbond initially, they were surprised. They thought the Superbond was a more recent creation. Yes. So just historically, the Superbond has been something that as a country we've been dealing with from 2006. We had the first restructuring. Well, prior to 2006, there was a lot of commercial borrowing. Yeah. You notice most developing countries, like we had mentioned before, traditionally have borrowed from what you call multilateral agencies, IDB, World Bank, etc., CDB, a regional bank. But in the late 90s and early 2000s, a lot of the emerging market countries, like what you call Belize, the Caribbean, started to tap into what you call commercial loans. So bankers in those developed economies, North America, the former Bear Stearns was our banker, tried to get better returns on their fees and higher yields for investors, and so they said, let's touch the emerging markets because they have to pay more. So we, like everybody else, tapped into that market, but the rates in those markets are commercial in the sense that you're going to be priced for risk. So on average, our rates on those commercial loans, which were about 15 commercial loans, totaling about $530 million, was on the vicinity of 11.25%. So that was just generally a high. And then the structures were difficult in terms of cash management. So you had what you call bullet payments and options. Now, what's an option? If, for example, you lent your brother some money and you said, but I want an option that at any point in time, I can take this little piece of paper and put it to you and you have to pay me back. We had what you call a put option. So some of the creditors were able to, at any point in time, put a large significant part of the borrowings to our country for us to pay. We couldn't afford those things. So those were some of the challenges early on. There was a default event that took place in 2006, a technical default, which is where we are now, where the administration just said, here what, looking at our cash flow, looking at what's coming up in the future, looking at where our economy is, we can't afford to make those payments. Let's start having a discussion about restructuring the debt. That's when the first Superbond one was created. If we jump to, I think, slide number four, slide number 7, just a quick look at that structure. 22 years, it was a 22-year instrument, meaning that it had that length of time, about $565 million, and we had some semi-annual payments that had to be made, and the bond was amortized from August. Now, myself asked me about the same amortization. What is it? It simply means that you start paying back the principal all along from 2007, when this bond was created, AK 2007, 20 February 2000, to 2019. So that's a period of 12 years. You would have only been paying the interest. And in 2019, you start to pay the principal as well as interest in equal payments over the next 10 years. So 10 payments, or you say 20 equal payments of principal. The other challenge with this structure, however, as we had discussed, is that the interest rate stepped up, so that by 6 years, plus 6 years, you're paying 8.5%. So it's a bond structure that at the time was considered acceptable by whoever negotiated it. But going forward, in the new administration, and this is in the UDP administration, subsequent to this, in early 2012, I think, we started to discuss, the new administration started to discuss looking at restructuring. And so that's the fall event again. So if we go to slide number 8, so in June of 2012, right, so just, you guess 5 years after the administration said, we are not seeing our way in terms of being able to debt service this, so we need to do a better cash flow. And all of this is about cash flow management.
I was going to say that, yeah.
Right.
So essentially, when the agreements are made for the Superbond, there is a forecast that isn't necessarily, I mean, it's worked out with economists, it's worked out with people who understand how the development or economy of a country should grow over time.
Yeah.
And that really sets the tone for these agreements.
Yeah.
So in 2007, the assumption was that we would be able to meet these payments.
Yeah.
2012, we realized it was not really going to happen.
Okay.
And once again, they went back to restructure. In other words, put it in payments that we feel that we could be able to make.
That's exactly right, Marlene. But let me tell you something about forecasting. My background is an economist, and I was a teaching assistant in grad school, and I taught econometrics. And econometrics, a huge part of econometrics is forecasting. And forecasting is a real beast, meaning that forecasting, only God knows the future, be honest with you.
Of course.
Well, it's like a weather forecast.
It's like a weather
what
forecast.
we try to tell people.
And when you do it statistically, the first year or two, you have what you call in statistics confidence interval.
Yeah.
How confident you are that your numbers are reasonably right, the future will be. After year 2 and year 4, and we have this what you call a confidence interval band, you should see these bands just explode out, which means that going beyond 1 year, 2 years, it's anybody's guess. But what we could say, it seems that the forecasting for that restructuring was what we'd call very optimistic. And optimistic means that you think all good things will happen.
Yeah, it was on the more positive side that everything would go the way it should.
Well. And unfortunately, whether you believe the administration or the bondholders' position that they feel that we can pay, basically the forecasts were not realized. Now, in terms of looking at potential Superbond 3, and if we can move forward, and I won't be doing any kind of comparisons, but in terms of looking at why the conversation came about with now looking at restructuring again, you had what we call a technical default when the memorandum of communication was issued on the 6th of January the 6th of this year, in which through the trustee, so usually in a bond process there is a trustee, there's somebody that communicates with bondholders as a whole. And this is slide 12, the government said, you know what, we're looking at our economic situation. We had the challenges with Earl. All the data is not good. Our productive sectors are not performing as expected. One of the biggest home runs we had hit early on, which was the discovery of oil. There were no further discoveries. Oil prices had collapsed. Our production of oil has fallen. So, it's just a very pessimistic picture.
And these are all things I think that actually the public is fully aware of. We knew that the agriculture industry took a loss. Shrimp was down because of that bacterial infection. Sugar had its struggle there. Citrus had its struggle there. Banana had its struggle there. Hurricane Earl happened last year. And then the final point which you have there is looking at the
compensation costs for the nationalization of BEL and BTL. And you also remember we also had the last of the corresponding banking relationships. So all of these, you call it all headwinds, all negative impacts on your economy. The administration felt that we need to revisit the bond structure. And again, it's all about cash flow management. We need to revisit our future cash expected payments because we're not seeing it forward. Bondholders have always been of the opinion that you have to be transparent. You have to show me everything. I have to fully believe that you cannot afford to pay what you say, what you have to pay, and then I might be willing to have a discussion. So the initial conversation is just an indication in this memorandum that there is going to be challenges, and we're going to be looking at, in the initial communication, the administration through its advisor said we would be looking at either doing a haircut or extending out the bond or reducing the interest payments, interest rate on the bond. So those were the three elements that were put forward. Subsequent to that, however, if we go on to slide number, let's see, number 16, this is what you call a consent solicitation. So with this slide, now you have a proposal. So initially, the first conversation was,
we want to renegotiate.
We want to renegotiate, and here are the reasons economically why we have to renegotiate. And then subsequent to that, you're coming forward now with a proposal. And the proposal is, here's what we're proposing as an alternative to what is currently the structure of the bond. And if we jump to that proposal, and I call it Superbond 3, and that's slide number 17, generally the proposal is to keep the maturity schedule. So 4 years, approximately 4 years have gone by, so this will now be a 21-year instrument. The amount of the bond, so there has been no proposed haircut, so we're saying we'll pay you with the principal what was owed. The maturity date is therefore the same. However, one of the big changes is in the amortization. So remember when we spoke about amortization, it's talking about paying back the principal. And the amortization initially was supposed to start in August 2019, and we paid semi-equal payments going forward to 2038. Now those scheduled payments have been pushed all the way back. So you're not paying principal anymore. Have been pushed all the way back to 2036, 2037, and 2037.
The final years before.
The final years before. So 3 large bullet payments at the tail end, right? And the other important change was that our interest rate on the bonds, or what you call the coupon rate, would have stepped up to 6.67%, thereabouts. At current, it's still 5%. The proposal is to reduce it to 4%, and there's no additional step up. So we'll be paying 4% going forward
to 2036.
To 2030 and 2038 when it matures, because then you start amortizing. So that has been the proposal. The response from the bondholders initially was, no way. We want to
I'm pretty
really
sure it
consider
wasn't
more
just
information.
a gentle no way in that room, but
if we look at something, and I just want to see, if we go to slide number 18, right? And what our firm did is we decided to make some assumptions. So as I was talking to you guys, when you're an investor and you're looking at the future, you're looking at your investments that has a series of future cash flows. So remember, all a bond is a sequence of cash flows into the future that I'm going to receive. And at the end, the final principal or some amount thereof. So what you do as an investor, if you want to compare one investment against another, which both investments have future cash flows, you use a word called discount those future cash flows, which is basically you try to determine what that cash flow is worth today. And I'll give you a very, very simple example.
Please.
So typically we think about things from present into the future. So you go to the bank and you say, I want to save $100, okay, for 1 year. What is your interest rate? So the banker says 5%. So if you put that $100 into the bank at the end of the year, 12 months from now, it's going to be $105. Your principal of $100 plus the $5 in interest that you've earned added to the principal. So the value of the $100 now, 12 months into the future, is $105. That's kind of how we grew up thinking about money, right? We're thinking about the future. Now, financiers and economists want to be complicated. That's what everybody don't understand finance. So instead of thinking about things from now going forward into the future, we tend to think about things from the future back to now. So the question would be, what would $105 in the future worth now at 5%? $100. So that's what the present value of $105. So let me go through the exercise again. So instead of thinking from now out, you go in, like I said, you go into the bank and you said, I have $100 in my hand. If I put it into your bank and you pay me 5%, what will it be worth in the future, 12 months from now? $105. The banker will tell you. Investors tend to think of it in the opposite direction,
way.
right?
Yeah.
Okay.
What is $105 in the future worth now?
So they look at their amortization payments in 2036.
Yes, so if
and
we
they
go to-
calculate it for what it would mean today,
Exactly. So if you
which
go to-
is 21 years, is it?
Yeah, so if we go to slide number 18, I believe, right? And I don't know if we can shrink this slide.
Yeah.
So what we did is we said, remember that the current Belize 2038 bond is just a series of future cash flows. That's all it is.
That's it.
That's all it is, a series of future cash flows for an investor, which means that on February the 20th, which is coming up right now, I am supposed to receive an amount, $13 million thereabouts US. On August the 20th, I'm going to receive another set of cash flows, and so on and so forth, and it goes out. So what you do is you're looking at each of these cash flows and determining what it is worth now.
Okay.
And to do that, you have to use this beautiful principle of what we call discounting the cash flows, right? And basically, you decide what should be a reasonable rate of return based on the risk. And that is you call your required rate of return, and that value is what you discount the cash flows by. So for example, let's go back to the bank example. If I was an investor, I'm putting my money in the bank, and it's out like saying, I think this bank is a reasonably safe bank. So for them to hold my money, I should only earn 5% on it. The risk of my money in the bank is 5%. So if I discount $105, 1 year from now to current, it's worth $100. So all these investors will do is they will take the two cash flows. So now you have Superbond, proposed Superbond 3, which is what we're saying with the 4%, the amortization schedules 2036, 2037, 2038 versus the current cash flow. So it's two set of cash flows, and you discount them into the present. Now, our firm did this at Legacy, and we estimated what we'd consider the net present value of the two cash flows, right? And for Superbond 3, our assumptions, now I have to be very clear, this is our assumptions.
This is your analysis,
Your
not
analysis.
the analysis
So
that the
legacy
bondholders are
do, yeah.
using.
Not the analysis of bond. They may use a different, very likely that they will use
It
a
is
different
a
discount
fair
rate.
assume that perhaps your discount rate was more optimistic than the ones they will use.
So we use 8%, right? 8% is where if you look at the current yield on the bond, it's about 12 or so percent. We use 8%. We said, over the long term, we think that might be a fair discount rate. The bondholders might use 10, 12%. The higher the expected return you put on your discounting, the lower the current value, right? So that's just one thing to indicate. And our net present value of the proposed new offer is $316 million. So that's what it's worth today, versus the current cash flows, which is worth, we said, about $464 million, which is as $148 lost in value. So if you're an investor, and again, this is our assumptions, if you are an investor, like when we're looking at that as an investment, purely as an investment, right, you might say, I don't want to lose $148 million in value.
That's a lot of money.
Right? So you may not decide not to do that. Now, there's a lot of assumptions that goes in, because you have to think out whether really and truly the country can pay that current bond flow, because it's better to get money than not to get money.
To get money, yeah.
So that's all of the considerations, but that's what we did there. And so that's where we think the bondholders would be at this time, trying to decide,
Yeah. Now, and I think this is one of the key areas to explore further, because a bondholder or an investor does enter into this type of agreement understanding that there is a certain level of risk. I mean, that is a part of how it functions.
yes.
Understanding that Belize's economy is where it is, and that government has put forward this proposal pretty much saying that this is the best that we can offer you. What is part of the process that takes place on the other end as an investor? You look at what the value is today, but how much do you measure that versus the fact that you simply want to be able to collect some funds off your investment?
So you're absolutely right. One of the things we had mentioned about where we think about the demographics of these bondholders is there's a set of investor funds that are called Vulture Funds, right? So it's very important for us to understand that the investors that are typically in these investments understand the risk. Meaning a Vulture Fund is an investment fund where you pool money together and you're telling your investors prior to them investing in your fund, these are the bondholders, that here what we're going to be going after high risk distressed debt. So if I'm a multi-millionaire and this is a bondholder and I'm pitching to you to put your money in my fund, I will tell you, hey, I'm going to look after, I'm going to invest in maybe Belize's debt and St. Kitts and Argentina. I'm looking at distressed debt where there's a tremendous risk, but I believe that we can restructure these deals in a way that will be significant, etc., etc. So first of all, you're not dealing with mom and pop,
I was going to
say, an orphan investor.
At the risk of stepping on some toes, and I'm going to go ahead and do it after the ruling this week, it's like what happens with some of the pawn shops or the payday loans. I can go to a bank and get a certain interest rate when I get a loan, but sometimes I know the bank won't necessarily respond to my request favorably, so I can go to a loan shark or to some of these other areas where the interest rate is so high, but I have a better guarantee on getting the funds I need. Is it?
It's exactly like that in a little
in what we can understand in our everyday life.
In terms of like the bondholders themselves are individuals knowing that they are messing with high risk borrowers, right? And so their expectation is a high yield. So risk drives return in finance, meaning that the riskier something is, I expect more, right? Less risky, I expect less.
I was just about to ask because I could just hear the question out there. Why would I invest if I know that this is high risk?
Higher returns, and usually the investors that are investing in those funds that are invested in, say, Belize's bonds. So we have to understand this is not mom and pop, widows and orphan investors. These are guys out there to make money, right? They're looking at what you call accredited, very wealthy investors, people who have millions and millions, billionaires of money, and they want to make a lot of money on their money, right? And so these guys said, we are great, we are fantastic, we know how to operate in this distressed market, and we're going to make money for you. So they go after the risky investments with the idea of making a lot of money, not a little bit of money, a lot of money on the investment. So that's something to be understood. They're out there to make money, but also to be understood is that they're managing other people's money. And when you're managing other people's money, you have to be very careful about what loss you are willing to bear, because you're losing other people's money, and whether you stay in business as an investor, asking people to put money in your pot. It might be another thing. So at this point, the bondholders are having to look at all of these things, right? And looking at, very importantly for them, is they're trying to understand what is the real economic situation on the ground, because that's important to determine whether it is safer to do a restructuring so that you can get back cash, or we should force an issue because we think this country can pay. And so those are the things.
Now, one of the main concerns, and we have heard the representative Charles Blitzer speak several times, and one of the things he keeps on saying, one specific term, the worry of kicking the bucket down the road. In other words, we're facing a possible third restructuring, which is that's what the aim is at this point. And their biggest concern is that we will go through this process, and a couple of years from now, Belize will come back again and say, we can't meet those terms, so let's renegotiate again.
Yeah, absolutely.
I mean, from what we have seen so far, government has offered a second extension in terms of having the bondholders come back and see whether or not they accept what has been proposed. But since the first refusal, if you call it that, there has been no change to the proposal. Is this just a hard line in negotiation saying, this is the best that I can offer, that's it?
So we're all armchair generals here, and we don't have the full data. It could be one of two things. Remember, the government is being advised by very experienced financial advisors in the market. They may have information we don't have in terms of one thing you can be certain with bondholders, they're not all collectively thinking the same.
Yeah.
Right? So although they have created, we have what you call a collective action clause, and so there's a group that has come together and said, we want to work this out. Within that group, you might have various individuals who might say, why, I want to cut and get my money. Some might say, I'm going to take a hard line. So you have different players also playing there. And so it might be that among themselves, there might be a realization that there is weakness among the group. You know, and if there's weakness among the group, there is a possibility of one or two breaking away and saying, hey, what, let's take a deal. So all of this could be in play. We'll know by tomorrow. I think February the 10th is the movement of the deadline, and so we'll know what takes place then. But if we want to look beyond the bond, because that's the issue, are we going to be able to put in place the financial adjustments? And we've argued the structural changes, because where Belize is, forget the administrations, where Belize is structurally our economy does not produce enough and consumes too much from the rest of the world. So what that means is every single year we run a trade deficit, and therefore we have to borrow to fill the gap. It's simply like if you're in a home, right? And then you're in this home and you consume more than your income. Every single month you have to go and borrow, and you might end up borrowing from loan sharks to fill the gap. And what happens if you don't change your behavior in the home?
You'll always have the same problem.
You will always have the same problem, right? So fundamentally, as a country, we have to change how we do things. So that means being more productive. We got to produce more and sell to the world more than we consume. And that's not something that takes place overnight. That's structural changes that has to take place. So in your productive sector, in your commodities, in your industries, in your service sector, in your education system, to generate that change. So short-term fiscal adjustment. So short-term fiscal adjustment means here what we're going to have to increase revenues from the government perspective, cut expenditure to generate a level of surplus that allows us to pay. But in the long run, medium to long run, the country as a whole, both parties, both third parties, private, public, labor has to come together with a structural program, a plan that is sustainable and reasonable, that will get us to that point where at the end of each trading year, we are generating a trade surplus or a service sector surplus, such that we can afford to pay for what we consume.
But you know, as an economist, because I like what you mentioned, and indeed the Ministry of Finance need to be more aggressive. But as an economist, do you see us or GOB at this particular point in a way forward in trying to get to this point whereby we're able to be much more sustainable, and then again be able to eventually export more? Do you see that as an economist?
Well, let's first speak about what we're speaking here, and I've not heard. We argue, so the recommendations, right? We argue strongly, and I argue strongly, that we must domesticate our international debt. I've heard other economists say, no, that's a problem. I've not seen anybody explain why. Because a debt is a debt is a debt, meaning either you owe John Doe outside or you owe John Doe inside, right? So domestication, the big argument for domestication from our perspective is the fact that you go from owing in foreign exchange, right? Which is, you have to go and earn that foreign exchange. There's no other way. If you don't sell something to somebody out there, you're not going to get US dollars. You can't print it, or your euros or rimbis or whatever. You have to earn it. Nothing wrong with earning it, right? But you have to earn it, and then you have to pay it out. So it does two things. When you domesticate your debt, you have to pay first one lump sum in foreign exchange. But the future interest expense, and if you think about a home mortgage, just go back to your home mortgage and look at your cash flow out. Often the interest payments that you pay over the life of that mortgage is almost the same value of the mortgage. Right? Now, when you have a foreign debt, the interest expense in US dollars that you're paying all the way out for 21 years, that's all that US dollars flowing out of your economy every 6 months. So when you look at that, we may end up paying $1 billion in US in interest expense out for 21 years. That's about the average we had calculated, right? Domestication takes that away. That $1 billion going out is not spent out. The interest expense is paid in Belize dollars and is paid internally to your own institutional investors, your pension plan savers, whatever. And we need savings, right? We need to save and we need to live on savings.
So this is why it's best to domesticate the bond.
This is my argument for domestication. The other benefit, if we go forward to, because I've listed the benefit very quickly of the domestication. Let's see. To put it up there for the investors. If we go to slide 30, 29 and 30, right? One of the things that nobody is saying, and this is why I'm trying to understand the argument against domestication, is that all of the two proposals, the Superbond 2 that we're paying now, Structure, and the Superbond 3, we end up paying the same. If at the end of the day we maintain these debt and we are good, we make good on our debt, we will pay $530 million US in principal. At the end of the day, forget about the interest. We will be paying back what we owe, right? If you can domesticate, and your private sector can domesticate the bond, because it has to come from a private sector consortium group, the bond is trading at about 50 cents on the dollar. If you can get it close to that amount, you're going to be cutting off about $43 on every cent. So instead of paying $530 million as a nation, at the end of the process, you may pay $300 million. So that's a tremendous saving that none of the two structures would offer you. Either Superbond 3 or the new proposed Superbond 3 or the Superbond 2.
So let me ask you a question, because this is a part of what you do in your everyday life, and that is seeking local investors to be able to purchase bonds for different developments.
Yeah.
Do we have investors locally that are willing to make that type of investment, especially on a high risk situation like what we see now?
So there's two things. We believe we do. We believe the money is in the system that can do it. And we
think the money is there, but is the willingness to invest in a high risk situation like what we're seeing with the Superbond, is the willingness there?
I think it is, because the same argument that I've made to you guys, risk drives return, right? So I'm not going to all the telemics of the domestication, but if you buy a bond for 50 cents on the dollar, right, and you're willing to give the country a haircut, Belizean investors are willing to give the country a haircut of say 20 cents on the dollar, and the government makes good on this debt at 80 cents on the dollar, these investors would earn about 23 cents on 57 cents, which is about 50% on their investment.
Yeah.
So what I'm saying is that it's a lucrative investment, but it helps your country. So I believe there are institutional investors that will be willing to make a lucrative investment. And the risk, remember now you're domesticated, the risk is in Belize dollars. We print the Belize dollars. So the credit risk has gone away. There's no credit risk. Obviously, the government has to maintain the fiscal position. So we still have to make that adjustment so that the payments for the debt now comes from increased revenues and decrease in expenditure. So that's something that we have to look at. Yeah. But going forward, and one of the things we did is we looked at certain metrics in terms of the total debt to country's population. So if we go to, say, a slide 33, you'll see that when you compare the total debt outstanding to the total labor force of the country, it's not that large. And if we argue, as I've always been arguing in my personal financial planning session, that as individuals we need to save, right? We need to save for retirement.
Yes.
We're all going to stop working at some point. And your savings for retirement should be significant because you have to live off that savings. And as Belizeans, we're living longer. The average life expectancy of most Belizeans, male and female, is longer. And our retirement age, even the one stretch out, is like 65. And a lot of Belizeans are living 10, 15 years beyond.
Yeah.
Now, you're not working in those 10, 15 years. So how do you continue to maintain the lifestyle, even if it's reduced, that you expect? You have to live off your savings. So as a whole, as a country, we have to save. And so the whole idea about this domestication is a way of getting all of that all together. We're not saving enough as a country, so we need to save more. And saving is a natural attribute of our labor markets, meaning that you work for a period of time, there's not a huge social network system. Old people don't live much with their families anymore. Kids are all over the place. So our elderly have to live on their own generally, and they have to have a source of income. Or retirees. Let me say retirees, because people say in retirement you can do a lot of things. You may travel, but you need income, and you're not working, so we need that income. So that's something that we have to look at. The final thing we wanted to discuss, I know because we're getting close, is what happens in a default situation.
Yes.
So if we go to slide 35, so let's say February 10 comes, and the bondholders, which is tomorrow, and the bondholders say, well,
Still not satisfied.
still not satisfied, and government say, well, we know we're battling all of these cases in the court. We don't know if we're going to have money. So I think the bondholders have to also take that into consideration, because all of these other issues taking place, you might say, boy, we better make a deal now.
No, yes.
So that I could get my money, because I know what happened next with all of these litigations, right? So that's something bondholders also have to factor in, and I'm certain why there's been an extension, because they're factoring that in. How does those legal cases play out in terms of, think about it, if the government doesn't make a deal now with them, or they don't make a deal now, and there's a seizure of assets, I might be locked out as well.
Yeah.
So all of that has to be factored in. But assuming February 10 come by and nothing happens, and the government says, boy, we're not write that check February 20th, then we're in a default.
Yeah.
Right? And now what plays out? Well, one of the things that our indenture agreement usually has, at least the last bond agreement had, is what you call a collective action clause, right? And that's CAC, and that group has already been formed. So collective action clause means that you don't need every single bondholder to agree to a restructuring for it to be, for everybody have to get it.
Yeah.
So it just means that usually it's like 75% is the threshold.
Yeah.
So once 75% or more, the majority of your bondholders agree to whatever the restructuring is, everybody has to buy in. And it makes it simpler. It makes it easier to resolve.
Rather than getting everybody to buy in.
Yeah, because they're always going to be the holdouts who are saying, no, I want, you owe me $1, I want my dollar, right?
Yeah.
So that is useful. We have that in place. So going to a default, that would be one of the first things that would kick in now. So what is going to be the offer that gets that 75% on the table to say, hey, well, we need our money. The other thing to understand is, remember we said that these investors are not mom and pop. So most of these investors, when they go into these investments, they take out what you call swaps or derivatives. Now, it's a fancy name, but what it is insurance. It simply says, if this person default, you pay me. Right? So, and there are individuals in the market that take on these kinds of products. So they offer to the bondholders swaps. So they're likely to get payout from insurance once the default is clear. Their default, the country is not paying its principal interest, and so they're going to get their payout there. Third thing, we know that we'll be locked out of the international market. So once we default, we won't be able to go to that market, and I mean international bond market, not the IDBs and the IMF and the multilaterals, but we won't be able to borrow right away on any kind of commercial basis until you resolve those issues, right? If we go on to the next slide, so some issues that I know, this is slide 35. One of the issues I know a lot of Belizeans are concerned about, and I hear it all the time, is devaluation. So where is that? A lot of countries like Argentina and Greece, they have a flexible exchange rate, right? And so what some of the things that happen is that their government tries to print money, right, to be able to pay their debt, drives or depreciates the value of their currency. And that's because the more of something you have in the market, the less valuable it is.
Yeah.
Just think about it that way. Now, that's a good thing if you have a strong trading country. Let's say you're a strong Mexico, or Argentina is one, where you have so much exports, your exports strong. A change in the value of your currency, meaning if it has less value, makes your goods cheaper in the global market, which helps your exports, right? So depreciation or devaluation for strong trading countries is a good thing because it helps you to be competitive.
But in the context of Belize.
But in context of Belize, no. We are not a trading country.
Yes.
So there's limited benefits from us devaluation. So I don't see us ever taking that route, because devaluation is a political decision, and that's what people have to understand. Government through Parliament will have to go to Parliament and say we're going to change the peg from 2 to 1 to 3 to 1 or 4 to 1. It's a political decision. It's not a decision that's when you talk about devaluation in that way, right?
And because we use our money to purchase outside so much, it's, that's what you were getting at with
we are consumption-based, import-based, so devaluation doesn't help. And therefore, it also would make it more expensive for government to debt service in US dollars, because now you need $4. Let's say we devalue it by half. The government will have to collect $4 Belize to convert that to $1 US to then pay. So the debt would the debt value in real terms would blow up, meaning it'd be harder for us to debt service in US dollars. So I don't see devaluation taking place. However, capital controls, we have capital controls, which means that if you have foreign investors, before they repatriate, they have to get permission from the central bank to do so. And just think about it. We can't walk around with US dollars. We can't have US dollar accounts, right? You have to get special permission if you're going to. So that's called cap controls. I see that if there's a devaluation taking place, those cap controls have to be tightened, right? Because what you're trying to do is now is to prevent leakages. Money is flowing out. You're trying to maintain as much foreign reserves within your economy or held by your locals as possible. So perhaps things like restrictions on credit card purchases, which Trinidad has done. So there's a cap on how much, almost every Belizean have a credit card. We go on Amazon, blah, 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 blah. So I could see some restrictions coming in to reduce consumption and some cap controls. And then when you go to the final step, it's really only God knows how the devaluation works out. Argentina fought for 15 years in courts from 2001. They had their devaluation, and only until 2014 was something resolved, right? And in all that, they continued to do business, obviously, but they had certain restrictions in terms of being able to go to the market. They were holdouts on their bonds. People were there. Some of the bondholders were trying to seize their navy and their president plane, and so it's just one long, nasty experience, and you don't know what comes out of it.
So let's because we are out of time at this point, but I want to close off with one solid point, and we ask you each time you're here, looking at what everyday John and Jean public need to understand about the situation. There are concerns of raise in GST. There have been, I'm glad that you explained the devaluation, because people have been concerned about devaluation. We hear of the litigation taking place currently. And we know that there is this massive amount of debt that there has to be a resolution made. We owe the money. What do people need to understand and pay attention to at this point?
I think we have to understand that there has to be some adjustment. There has to be some adjustment in the country. And like I've said before, there has to be a conversation across the three pillars of the economy: labor, private sector, and government, as to how this pain is going to be shared. Because it's a pain sharing experience, I think, meaning that something has to take place. The government has to find a way of reducing expenditure. There's no question asked, whether it's this administration or next, they have to find a way of reducing expenditure. Now, reduction of expenditure means that somebody is not going to get what they want. Right? Recently we heard, when they had the opening of the Supreme Court, there needs to be additional judges. Well, that's going to be a cost. If you go to the education system, the people there will say we need more money. If you go to the healthcare, they'll say they need more. Everybody needs more money, even at the current expenditure that we are. Now we have to cut. So where is the willingness going to come from in terms of those? Then there's labor, right?
And labor. The recommendations we've been hearing regularly is the increase in tax and the cut in wage bills. Wage bills equate to jobs.
Well, I have to be like a supporter of Chamber, and I am strong in my view that I think increasing taxes is one of the worst things we can have. The economy is already slow and struggling, and any good economist will tell you in that environment you don't want to create an additional headwind, and increasing taxes is a headwind, right? So what needs to happen has to be something else in terms of adjustment, because again, taxes is a barrier to productivity, and it is a necessary barrier. It's necessary to fund public goods and services, but where your economy is struggling, you don't want to look at taxes as your first. And I also think from the administrative perspective, that's what I'm hearing, that they don't want to look at that as a means of solution. So it means now, if you're not going to be taxing, it means you have to do some expenditure cuts, more so than, so those are the things. So then like I said, there is the need to have this conversation, but at the household level, we have to try to save more. We have to try to see how much more local goods we can consume, right? So local consumption, maybe we have to cut back. So this is what I say, there's a country behavioral change, right? So if there are things that we can consume locally to increase our local consumption as a household, we should make every effort to do so. So, and that might be better for us, healthier to go to the market and buy veggies than buy the tin products, right?
Yeah.
Now, this will affect, of course, our traders, but we have to collectively do that. I think we have to look at ways of trying to save. If we can carpool instead of everybody driving their own car, you know, if we can catch a bus. So we have to look at saving as individuals, and the country has to look at saving as a country.
All right. Well, Ervin, thank you so much for coming in
Welcome.
this morning. We appreciate you being here and definitely shedding light on the Superbond and the way forward. And of course, we will continue following the situation. So maybe we have you back to explain what is actually decided later on.
No problem.
We're going to go ahead and take a break now. When we come back, it's to speak to representatives of the Ministry of Health about the HPV vaccine rollout. How did it go? And what can we expect next? So that's coming up after the break. So stay tuned.